All right. Good morning, everybody. Getting closer to the end of the week, to the big job numbers that we've been waiting for. This is Jobs in Focus number 3, and it continues. Slightly green this morning. Little fluctuation. They were all up a bit more. Kind of gave it all back. NASDAQ starting to dip a little bit into the red. We didn't get much out of Japan last night. I expected, well, we had the potential for more. Let's just leave it at that, I suppose. This number could get some activity today. It's a pretty wide discrepancy between minus 140 and minus 63. That would be the difference between the forecast and the previous number. So that sounds pretty hopeful. And we also got to listen for any revisions of that previous number. So let's just see what we get. But 8:30, just kind of keep your eye out because that's a it sounds pretty rosy, right? All things considered. Maybe they're blowing a little bit of smoke. Sunshine and rainbows. ECB right behind that at 8:45. And then an auction in the front end, the 4-week. You could probably just use the IRX on that. And Fed through the afternoon, but not looking for anything out of the Fed, really. They're just pounding the same drum. Thought there was something I was going to hit on with nat gas, but I guess it doesn't matter anyways. Really not much to nat gas at this point. I believe Johnson supposed to be on Bloomberg yesterday, or maybe it's today. So the markets could get more on this, fight with the bill. And, if it gets sent back to the House again from the Senate, which is really likely, whether or not it's going to have a chance to get through the House again, markets could react on this a little bit. The call wall and put wall are now completely above the volatility trigger and zero gamma. So we're in a positive gamma environment completely, right? We're not just kind of poking our head through and crossing back and forth. So we want to be mindful of the typical gamma environment. If you're unfamiliar with this logic, it's the idea of what will dealers do when fronted with strength or weakness. When we're in a strong gamma environment and we break to the upside, they will sell into that strength. And if we break to the downside, they will buy into that weakness. It is their focus just trying to offset their risk, right? They're not trying to manipulate markets, or they don't have an agenda of where they want price to go. They're just trying to remain in a zero gamma environment, or a zero risk environment, right? That's their only focus. So it's why in good, clean, bullish markets, we generally grind higher with nice small candles. That's kind of the why behind it, right? It's why we get those uniform, good, small candles where we just keep going higher and higher and higher every day, right? It's because of that environment. It's also why in bull markets, our average daily range is smaller because we have that headwind that every time we try to break out and go higher, we have dealers selling into that climb, and so we don't climb very far. It's why in bear markets we have those really big candles, because in a negative gamma environment, if we fall, they will sell into that, and then we fall more. And if we run to the upside, they'll buy into that and we'll run more. So we are in a narrowed daily market environment. We're this high up into positive gamma and we attempt to break out, they won't be buying with us. They'll be selling into that. And it doesn't mean that we can't break out. It doesn't mean we can't have a big day where we run higher or where we fall lower. Just that we will have headwinds from the dealers. And with that in mind, you would want to know how much do the dealers need to offset today, right? Because they've got levels that they need to maintain, and they need to be zero at the end of the day. They have X amount that they have to offset every day. Some days are larger than others. So if they have a lot of work to do, then we can look out for that. The overnight volume, again, in line, really close to what we had yesterday. So nothing out of line there. We are above all of the major moving averages. And the call wall is a long ways off. So having both of those walls roll up is a bullish behavior. It doesn't mean that we're going to go higher. It's just posturing, right? That's a bullish posture to see those things get moved up. The markets are clearing a path for price to rise. So, if we look at what's more likely, it's more likely that we rise and continue to drive towards the call wall. It's less likely that we break a put wall and fall back into zero gamma and the volatility trigger. Just keep in mind, price can do whatever it wants. And we're not saying that we can't go down here, just that it's more likely that we go up. We're basically flat this morning, right? We haven't gone anywhere. We haven't done anything. And we are where we were last night. And if you think about this overnight that we just had, it's a fairly narrow IB. IB is the initial balance. So what did we really get done from, the open last night into Europe's open? We didn't do anything. Then Europe opened and we got the pop, and now we're just coming back down trying to close that gap, right? So it's a liquidity gap. So the pop itself, obviously based on some sort of headline or economic news out of Europe, and it's just getting washed back out. Even the fade back down isn't bearish any more than the pop to the upside was bullish. It was just a function of a headline or some kind of news, right? So that'll put us back where we were. And then we're stuck looking at the same question. What are we going to do today? We looking bullish, looking bearish? We got any reason to expand or contract or go anywhere or do anything? And the answer is no, not really, right? We've got a few headlines, nothing really big, some threat that I already pointed out. And then otherwise, we're just waiting on tomorrow's data. Tomorrow's the big one. So we could get a headline that moves markets, especially if it's a quiet day and the market's looking for a reason. Other than that, in a positive gamma environment, we're sideways waiting on big data. Even if we try to get a breakout without headlines, where's it going to go? Very likely not far, right? We're going to just come right back in the range again. Since we are basically where we opened, we have a chance to go to either ADR today. To do that, we would have to get a breakout either of the upside or the downside. A lot of times that's not true, right? A lot of times we can hit one edge or the other without getting a breakout first, but not today. So this is the entire range for yesterday. Should be fairly easy to get outside of that box. And yet, here we are, and we haven't done it yet. It's a very narrow range, 25 points. Our average daily range is 82 points. Even the one standard deviation is 60 points. And the daily expected move is 50 points. So this 25 points is really light. We should have at least 100% more of that in one direction or another. Well, if you take 100% of this to the upside, you'll get to the ADR. If you take it to the downside, you don't quite get to the ADR. You're moving in the right direction. So GTFO, right? Get out of this box, and then we've got something to work with. To the downside, we're still going to be focused on Tuesday's price action, just like we were yesterday. So we can run the midpoint of Tuesday's price. It is still a valid level. And then below that, we would deal with the ADR. We got some cog lines down there, some options levels like 59.50. Then we've got Tuesday's low and the full ADR, which also happens to be another cog line. Both of those are on a cog line, 59.32 and 58.92. Yeah, I'll take it when I can get it, right? And the midpoint landed right on an options level, 59.50. It's interesting to note that we're holding the 786 of that Tuesday measurement, by the way, which continues to define for us that as long as we maintain 786, we could run back up, break 100, and try to push through the 111 and the 1236. The 111 is an options level, 6,000, and the 1236 is a cog line, 6011. Just love how that all works out. If we break 786, it opens us up for the half. Get through the half to get through the ADR, get through that to get through Tuesday's low, level by level, right? The thing is, though, we're really not expecting much out of this yet. We have to keep reiterating that tomorrow's the big day. So while a headline could shock us out of this malaise that we're in, this sideways action, it's more likely that we wait. That's the base case, that we wait for tomorrow. Today's floor pivot is higher than yesterday. That's a bullish bias, but price opened underneath it, and that's a bearish bias. Those two kind of cancel each other out. The channel is narrower today than it was yesterday, but it's still a wide channel compared to how narrow it could be. It could be so narrow that you don't even see a channel. You just see the purple line. A wide channel implies that if we break out, the breakout doesn't stick. Like yesterday, we tried to break out of Tuesday's range. It didn't stick. We came back in. Now, we really didn't do anything Tuesday, but you get the idea. It's not a perfect system. You can see that on Tuesday, we had a wide channel, and we easily broke out of Monday's range, and we kept it. We kept going, kept running. So it's not perfect. It's just giving us some insight on what to expect out of price today. We're still above the weekly pivot, 59.11 cog line, and we're not overextended, meaning the distance from where we are right now to that weekly floor pivot is not too much. If it was, we'd have to worry about some mean reversion kind of coming back, but we haven't gone too far too fast, and we're not worried about that. If we do begin the expansion today, it's worth noting that we've already gone to R1, and there's an old school floor pivot play that goes from R1 to S2, or the other way around from an S1 to R2. And since we've already popped and jacked into R1, that does open the door for an S2. That'd be 59, 58. And that would make sense too if we're going to hold the line and we just drop down into that level and stall out and then come back in again, right? If you look at how narrow the floor pivot is today, the entire thing with the S and R levels, it's very small, right? This is the whole range. Take that and compare it to something like yesterday. Yesterday's range, that was only the R1 and the S1. The whole range is much bigger yesterday. This is based on how much we move, right? So every day it looks at what we did yesterday and calculates today's levels. And since we had a 25-point range yesterday, today's range is really narrow. And we've already hit R1. We could easily hit S2 today. That wouldn't make us bearish. That would just be starting a megaphone pattern, which is what we would expect once you get price in a range like this, is that you start breaking the range on the upside and the downside, and it gets a little wider, and you end up getting some sort of megaphone pattern, right? Before it finally breaks and really goes to the upside or the downside. So a downward expanse down into S2 makes sense if we can break our own Globex low. What we've been looking at all week, the range continues. We don't exactly have the classic P-shaped profile here just because of all this trash earlier in the week. But, you know, all things considered, it's pretty good. And the point of control is up here with us, defining this range and this structure that we're working with since yesterday. It's a really tight structure, right? This whole thing is Wednesday's price and now Thursday's price. So we're building it out really well up here. If we lose this zone, it will be very hard to come back up into it again, right? So the idea behind it is we can chop here and go back and forth through that level, maybe even widening out as we go to kind of build that megaphone pattern we're talking about. But if we break the structure here and we really fade down, say we get to the value area low here, and then we try to run back up, this will be a restrictive area. It'd be harder to get through it. Much like this. We left the range, we came back, we got into it, but we really had a hard time getting through it. Ten-day, 30-minute volume profile in TPO. We're building it out up here. It's very likely that this point of control is going to move up into 6,000. The question is whether or not we're still going to be here by the time it gets up there. It would be better if we're above it. So, you know, like we're into 60-20 or 60-30, and the point of control gets brought up into like this 59.92 cog line, something like that. It would not be cool if we sell off and then we end up having that point of control move up, and now it's over our head and we have to deal with it from that point of view. Give me a second, guys. The dog needs back in. typically she's a sleepyhead and sleeps through these morning briefings, but she got up early and wanted to go outside. So we got the distribution point of control, TPO, for today underneath us. The idea is same as what we've been talking about. The zone now needs to hold. If we break that, we can expand to the downside. And we don't have a VPOC for today because we've already hit it. Three and a half percent above the 10-week. It's all right. We're still less than 4. It's kind of the line in the sand we don't want to get beyond. And we still haven't reached the edge of the week. This is how far we were expected to move within the week, and we were expected to close within this range. So far, we're on track to do that. Now, I say that's what we're supposed to do, but we go through periods of violence where we continuously break that range and close outside week after week after week. It's supposed to have a 1 standard deviation, so a 70% accuracy to close inside the box. But the S&P, whether it's SPY, SPX, ES, is the most heavily traded product in the world. It's got the most accurate expected move and generally closes in the box about 80% of the time, which means you can just count back 10 weeks, right? You don't have to count every single week on the chart. You can just extrapolate. What did we do in the last 10 weeks? We should close in the box on Friday, 7 out of 10. 8 out of 10 if you're looking for the 80%. And if you count back over the last 10 weeks, we haven't done that. That highlights when things start getting out of control. Either they're not pricing in the volatility that we're seeing, or we're getting more volatility than they priced in. Markets are exceeding the expected move on a week-to-week basis, which tells you don't run iron condor trades, for an example, because you're likely to get blown out. Tells you you're not being compensated for the risk you take, that doing premium trades in that environment likely won't pay you well for the risk you're taking. And that's the environment we've been in. So sure, we're supposed to close inside the box, but we have been consistently failing to do that. And until we get our average back, I wouldn't try to run the strategies that we typically would run along these edges, because we're just not in that environment right now. And on the 10-day, we're not even 1% away from the 10-day. Right now, we're just holding in this zone, this range. And that's typical. If we look back, there's been a lot of periods in time where we just hold the range within, say, 1% above or 1% below, and we just chop. It's fine. It's healthy. There's nothing wrong with it. And in those periods of time, we could see we had good market conditions during that, right? Because it was just, everything was just nice and normal, just toe the line. Everything's fine. So we're in that environment right now. We're not overbought. We're not overextended. We haven't moved too far, too fast. It's healthy. And the longer we stay in this condition, the healthier the market is, the stronger it is, more resilient to impact. Looking at what's down this morning, really nothing more than nat gas. And for what's up, uranium, China, precious metals, that's it. That's nothing. silver, gold miners, solar, bonds, gold, uranium. That's it. You don't rally on that stuff, right? At least you don't want to. Definitely don't want a rally day based on solar. So we want the Mag 7, financials, consumer discretionary, technology, cloud computing, some chips. We want those things for an S&P breakout. We would want those for the downside if we were looking for a breakdown. We would want to see those heavy in the negative space. We got mags down 0.25%, but that's not enough, right? We'd need 0.5% or more. And mags, if you're unfamiliar with it, is the Magnificent 7 ETF. So it's like the NY Fang, except that it moves in pre-market, which is nice. Airlines are down, but that's fine as well. They're not big enough to take the market out. So we don't have the influencers up enough or down enough to move us around. Since we don't have options flow, we can't look at that yet this morning. Dollar treasury and yields are not really rocking the boat, so to speak. Take that back. Yields are stretching their legs a little bit. 4.32 would be the level of concern. As long as we're holding above 4.32 today, then shouldn't be an issue. We get below that today and we could see some impact. Tomorrow it would be a different number, right? These swag lines change on a day-to-day basis because it's more about how far do we have to go to hit that level versus, you know, some static line in the sand that never changes. So this is a bit of a drop, getting below 4.2. And you can kind of see how we were falling here and we were rising here. And that would make you think, oh, well, that's great. We keep falling in 10-year. The ES can keep rising. The NASDAQ can keep rising. Yes, but there's a limit to that. When it comes to the 10-year, it's supposed to stay in a range, much like oil or crude. You don't want it to get out of control. 10-year too low, yeah, that breaks things. 10-year too high, same thing, that breaks things. So fading was a part of this drive up for the ES, or it certainly helped. But if we fade too low, then it's going to start causing issues rather than helping, and it's going to be the other way around. Which, by the way, in this fade meant that we had stocks up, bonds up, right? I know that's pretty obvious when you think about it. But again, that dynamic will break if it gets stretched too far. So keep your eye on the 10-year this morning. It is continuing to expand to see if we can get into that swag level or not. You see the range that I'm talking about on the 10-year TNX. And even within this, if we get too high, markets react. If we get too low, markets begin to react. So we want to kind of stay in that sweet spot. And for today, this is already enough, more than enough. We don't want to upset the apple cart. And I know this candle is red, but for those who didn't catch it, it's hollow. That means we closed up here. And it also means that we gapped down to here and then we fell all this way, right? We didn't gap up off the low here and then fall. We've been falling. So 4.32, very likely the enough is too much level for today. this is a fairly easy layup kind of day. You've got a very tight range. It's really clean. And we have really no expectations of headlines beyond the 831. The rest should just be noise. So if we break out with any kind of strength behind it, look for the why behind it. Either options levels are coming in with strength, dollar treasury yields moving. It should be a standout item, right? At this point, we're not in a position where I think that we can, get one of those spot up, vol up grind days. I just don't see that we can get that today. So there's likely to be a headline behind it. Otherwise, look for the megaphone to expand the edges, and we will be focused on tomorrow with non-farm payrolls. Pretty simple. Everybody, be careful, be safe. I'll see y'all tomorrow.